This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 5th. Some highlights from today's show. Google disappoints, Meta is now the last man standing, and US bonds are flattening into non-farm payrolls. Hello and welcome traders to another daily market rundown. Let's get stuck straight into it and turn our attention to our first bit of news, our first bit of overnight news, and that's very much again on the theme of tariffs. We did have Trump coming out yesterday. There was a little bit of expectation that Trump and Xi Jinping would have a conversation yesterday. It didn't. It was reported by the Wall Street Journal that they're not in fact going to have that meeting. There's a little bit of optimism, the fact that they were going to have a meeting so quickly. The thought was, if they're going to talk quickly, it means perhaps we can definitely, perhaps remove some of the tariffs, a bit like what happened with Mexico and Canada. That did not materialize. The result was Trump in the White House was asked about it, and Trump kind of said, well, look, it's fine, and asked about those retaliatory tariffs. He kind of shrugged it off as if, well, okay, it is what it is. So what this kind of speaks to is this idea that there's not necessarily enough pressure on both sides to come to the table and talk. So what we would typically see in this, if you think a bit of game theory, we typically see a little bit more escalation. Okay, now what that might come in, and I suspect what's going to happen is you might get a little bit more rhetoric from Trump stepping it up, saying, well, look, they retaliated and we agreed that if someone retaliates to our tariffs, then we'll just put on more tariffs. So I suspect that's next. I think that's what we get next, perhaps today, tomorrow, is some sort of a one-liner that says, well, look, if China is going to impose retaliatory tariffs, we then can impose more tariffs. Something along those lines. So again, it's a very dynamic market situation right now. The market is going to move up and down a bit like a yo-yo on these types of commentary. So do pay attention. Not great markets to be holding long-term positions on because they are going to be quite volatile. Now let's turn our attention then to the second key news, and I think this is very, very important for today and particularly for the rest of the week. It's Google. Okay, we've obviously now got pretty much the Mag 7 out of the way in terms of reporting on earnings, and Google came out and again disappointed, very, very similar to what we had from Microsoft, where we had a little bit of downbeat on their cloud revenue. Very, very similar. Cloud revenue growth slowing. Same thing with regards to Microsoft last week. And we know Microsoft finished the week somewhat down on the week. I think it was 6% down odd. So the key takeaway, I think, from this, so there's two parts. This one was the miss on the cloud earnings, but the other part was the infrastructure spend. And I think the market looked at this as well. Hey, they really are, sort of stepping up their capex spend for this year. That's technically positive given the whole DeepSeek conversation that's going on. But the other side of the coin, of course, was the cloud revenue. Now, the key takeaway is that pre-market, the market is down 7.2%. Now, I think that's fascinating because what I think the market's now starting to latch on to, and it's right at the bottom here, the commentary that was made is this quote says, DeepSeek started to teach the market that maybe some things can be done a little bit more efficiently, and maybe we're starting to see the market dislike continued increase in capex. In other words, maybe investors are now starting to look and say, hang on a sec, these guys are just spending money so lavishly, kind of just shrugging off the risk completely. I'm not sure I really want to be long of this stock when it's so overvalued at a time when there are these sort of risks that we just don't yet understand. And so I think that's an interesting take. I don't think it's a consensus take. If it was, we'd be down probably 5 to 10% lower in the NASDAQ. But I think it's an interesting take that I think you've got to watch very, very closely because perhaps the new narrative becomes now that overspending on capex is not necessarily a good thing. Okay, that being said, of course, Sundar came out and he said, well, look, the cost of, the reason why we're spending so much on CapEx is because in reality, because costs of AI are going to come down, we're going to need a lot more capacity. Okay, very similar argument to what Microsoft made, which was, well, look, if it's going to be cheaper to run AI, everyone's going to want AI. Okay, now again, yes, technically there is a theory that holds true, but it doesn't hold true overnight or for a week or a month. This is something that, 10, 20 years from now, sure, we'll all be using AI to some degree, but right now, you know, the market is perfectly priced for perfect earnings for a perfect future starting tomorrow. And that's what we have to deal with, which is the market valuations are very, very elevated given what we have today, 3 months from now and 6 months from now. Now, keep this in mind, the 7.2% down, because it's going to add on to what I think the theme is for today and over the course of the rest of this month. And it turns our attention, of course, to Tesla. Tesla's also in the news, but perhaps for all the wrong reasons. And I think this is definitely worth a read. The point is that since Musk came into power, he seems to have pissed off quite a few people. Obviously, he is sort of quite aggressive on Twitter now, and some of his views can come across quite strongly. We know that he's now leaning and supporting, far-right parties in both the United Kingdom as well as France, as well as Germany. The result is consumers are saying, well, we don't want your Teslas then. Now, again, this is going to prove problematic for Tesla. Again, what has driven Tesla's sort of valuation? Well, I think it's a combination of things. I think it's still being treated as a tech company, and obviously it is priced like a tech company despite the fact that it is actually just a vehicle company. Now, yes, in terms of technology stack and all that, I get the whole logic about why people want to hold it to the moon, but the key takeaway is near-term sentiment is that they are seeing a significant drop in orders in the near term, which means build up a supply, which means perhaps not as many deliveries as expected. Now, the key takeaway, and I think why Tesla is going to become a prime target for short sellers, is very simple. Notice the rally we've had since the election. Okay, we've almost doubled in price on what? It's not a significant change in demand for Teslas. We know that now. It is very much this idea, well, he's coming into power, easier policy, easier route to get his car out there, etc., etc. Keep a very close eye on Tesla. I think sub 380s, Tesla is going to sink hard and fast. I think it's going to be attacked by short sellers, and I think it's one you've got to be looking for fresh shorts below that 375 today. And don't be surprised to see this come all the way back down and fill in that election gap down around that 260 mark. Again, not going to happen in a day or a week, perhaps not even in a month, but very much the news is now turning quite negative on Tesla, and it does warrant your attention. Now, this is a very interesting one, and I actually just need to quickly remove this away so that you don't see it. Is I want you just to pay attention to this grid, because what you can see here is the Mag 7 in essence. Now, why do I bring this up? Well, look, Mag 7 has driven the last 2 years of returns, which means when everyone decides they're going to start scaling out of these trades, Mag 7 is going to drive the down move and the corrective move coming into the equities, which I suspect is coming in the very, very near term, and perhaps even starting today. Now, I've labeled this as Meta is the last man standing. Why am I saying that? Well, we know Nvidia's finished. Okay, we know the theme and the bullishness around Nvidia has suffered a significant setback, and that's not going to resolve itself in the next month or two. Okay, Nvidia is going to be a target for short sellers for some time now until the AI narrative flips over. Okay, Microsoft, another one, massive spending on capex, not quite getting that cloud revenue. So the theme and the narrative around Microsoft has dropped. Apple, well, guess what? That narrative stopped last year already. Apple was a massive underperformer last year, and again, it's down 7% this year. So that's been gone for a while. Tesla is now a fresh target. Like I said, they are going to be targeted very closely in terms of short sellers. Alphabet has just fallen. We're now going to open flat for the year. That has now fallen. That has fallen into the same bucket as Microsoft, which leaves us with one platform left. It's Meta. Okay, now, can Meta keep it all together? Absolutely not. Will Meta outperform? Absolutely yes. But the point is that the Mag 7 drove us up 50% in the S&P in the last 2 years. It's now a case of this is going to be driving the indices a lot lower. Keep a close eye on it. I think the basket of Mag 7 is one to watch. I showed you that chart yesterday on the market rundown. Keep a close eye on this. I think we are now in the final stages of this process that people are going to start accepting that some of the returns from the Mag 7 are just not going to be what they expected and what is actually priced. Okay. Now, our next theme, and let's talk a little bit about bonds, because bonds are talking very loud, and when bonds talk, we listen. If you go back and you look at the start of the sort of trade yesterday when the pits opened around 1:30 London time, we literally staged what we call a one-time framing 60-minute chart. In other words, the market just all day bid up the page. Okay, it didn't stop bidding. We initially started there with a little bit of a steepener, and we flattened out completely. Now, coming into Europe today, it's carbon copy setup. We're flattening across the board. I mean, US bonds are up 0.3% on the day. We're almost up a full point over a course of 24 hours. What's changed? Well, it seems as though there's a little bit of a growth fear coming into the equation. Bonds are sniffing out some degree of a growth fear. Why do I say that? Well, this actually started in Europe last week, led by the German bonds off of those really bad unemployment numbers that we had, as well as the break-even inflation's dropping in Europe. So that's where it all begun. And now, after yesterday's JOLTS numbers, we're starting to see that theme follow through into the US data, into the US bonds. Okay, the point is the curve is flattening. If you go look back at this high made on Thursday, it was quite a key auction reversal. I suspect that gets taken out and we rally our way back up towards that FOMC high. It also, if you look at the yield chart, it makes absolute sense that we now rotate our way down to that 408 yield, and you see that we are very much stuck between a 408 support in yield up to a 440 resistance in yield. That is, for all intents and purposes, the range we are going to remain in until we get some form of a catalyst to break out of that. So bonds are very, very much in play today. I think you've got to watch for volumes to pick up above that 109.15, and I suspect we do then scale our way back up towards that 109, sort of 110 area. Okay, keep a close eye on that. I think in bonds bidding, don't be surprised to see those equities pair off a little bit on that Mag 7 theme. Like I said to you, it does seem like we are now in the beginning process of a corrective move for NASDAQ and for the S&P 500. Now, with that in mind, this was cut off yesterday. Apologies for that. But this is effectively the chart of the NASDAQ. And what you can see is that, look, this has been a fantastic trend. We can see a series of higher lows, lots of higher lows, holding, always holding, always holding. Right now, however, we are in some form of a topping out pattern. You can see we made a record high late last year. Of course, the Fed intervened with a more hawkish sort of outlook. That created the top. We now created a second lower high off of the whole AI Mag 7 concerns. Now we also have the tariffs coming into play. Don't be surprised to see this NASDAQ begin the process of moving its way back down towards the first level of support, which is around that 21,000 mark. Now, if you go look back at the 2021 topping process, it's always good to look at how markets top and turn. But if you go look back at 2021 and how the NASDAQ turned, it's quite an interesting study, quite a lot of similarity between the patterns, which was we had a magnificent rally throughout the whole of 2021. We made a very aggressive reversal at the high, very similar to what we saw in the Fed there. You can see how aggressively we turned off the top. We had some form of a nice correction. Then notice how quickly it got bought up. Okay, V-shaped reversal, V-shaped reversal. Okay, we then had a secondary go lower, a secondary go lower, V reversal. Okay, so in other words, dips are very quickly bought up. Now, one thing I like about this, and this is typically very unusual, is that when a market is trending very, very strongly, what you should not be seeing is a flatlining of a 20-day moving average. Okay, and we saw something very, very similar in 2021, which is we started to see price flatten out. Now, what this typically suggests to us is that momentum's gone. The move's finished. It's come to an end. Now, why that matters is because we've got record CTA activity. They are all buying it up here on this recent momentum. Everyone's getting long right at the point of a top forming. Okay, and that's ultimately what creates that very aggressive washout trade, is that everyone just gets long after a very, very aggressive move up that has got no more momentum. Okay, that's the key takeaway. What we do notice as well, if you look at that 2021, we made the lower high. There you can see it. Then we had the correction. We seem to have made that lower high now. We can see there's the AI fill of the gap. There's the gap from the tariffs Monday effectively. Don't be surprised to see us start to begin to offer today. I think the Mag 7 is going to lead that down move. And then, like I said, 20,000 is, or just below there, 19,800 is the first real area of interest. But again, how much this corrects by, I don't know. I just know that we are heading into a near-term correction. All the signs are there for it. And like I said, it's going to be very much led by the Magnificent Seven. Okay, that's then a wrap for today. If there are any other questions, do post them in the Discord channel. And I think the key question for today is, are you bullish or bearish on the stock market? I think it's always good to get a varying number of opinions and comments. So yeah, what are you? Are you bullish up here? Are you bearish up here? How much upside do you think you have? And how much downside do you think you have? Post those in the comments. Always good to get your feedback as well. That's it for today then. Good luck out there. Manage that risk. Go make some money.